labor market, which is the last thing, right? It's the lagging indicator, right, through this whole thing. And that now these are the signs, and maybe they were there for longer than we realized, given the revisions and claims, that the labor market is about to roll over in a bigger way.
Yeah, I think the labor market is going to, I don't know if it's completely roll over, because people still have memories of how difficult it was to hire people. So until they see more than the negative data that we've seen actually impacting their business, it's going to be tougher for them to let go. We've seen technology do it, but technology was not unique in hiring more people than needed, but unique in hiring so many more people than were needed. So they're the first to go. I think you'll see others follow suit. But look, it's what we're looking at, to Jim's comments, I mean, it's a moment in time. You can take a look on a daily basis about data, and let's just go through it. What's gone down over this past month? Used car prices, retail sales, industrial production, durable goods, ISM, consumer sentiment, factory orders, JOLTS, Costco's news. And then look what's gone up. Wages, crude inventory, and jobless claims. All those are the same thing. They're telling you that the Fed action, the tightening cycle, is just starting to hit. So if you think that this is the end of it, Jim, because that's where to your point, that ISM is down, but I didn't see but it's actually good news that it's down. Everything can't be good news. It's just the beginning of what's going to be a precipitous decline in the economy, abetted by a tightening credit cycle that the Fed didn't count on from what we saw. They saw the credit cycle tightening, but not to this extent. And then throw in commercial real estate. So to me, there is no other side to this market argument at all, period, end of story. Because you've seen multiple expansion. If you just reset to what makes common sense, you've seen major multiple expansion, while you've seen earnings estimates so far go down 7% for the first quarter. First quarter, you'll see more as we go through the year. So yes, you should sell some stocks.
So Jimmy, I'll come back to you. Weiss is taking the onus off you yelling at me again, but please, I mean, you have a retort of sorts for that?
Let me cut out the emotion and just go to what I think is salient. The last thing he said about earnings revision, Steve, I mean, that's a fact, right? That earnings for the market overall have come down. What's also a fact is that this is a great stock pickers market. I can call out a lot of stocks, and I'm about to, where the earnings revisions are going higher. And that's where I want to be. And Steve, you know me. You know I'm a stock picker, so none of this surprises you. But take a look at Transocean's earnings revisions. Take a look at Wynn Resorts' earnings revisions. Take a look at Cleveland Cliffs. These things, some of them are going up. Now, I will tell you, I don't want to be in the market overall. I want to be in the stocks that I pick where I see earnings are getting better. And you can do that. You can do that in this market.
Josh Brown, let's get you in here. Morgan Stanley's Mike Wilson today said market is signaling to stay defensive. A lot of talk about the yield curve re-steepening, right? That's happened in a pretty big way. We talked about the data is, raising some alarm bells, and those revisions today on the jobless claims leading into tomorrow certainly are interesting.
Yeah, if you look at the shorter end of the yield curve, the 1 month, the 2 month, the 3 month, all of those are up versus the start of the year. The entire rest of the curve, anything from 6 months out to 30 years, are now lower than the start of the year. And the big story of this week is yields crashing. It's really been breathtaking. The volatility in yields has just been absolutely off the charts, which is not something that I expected to see. But this is where we are. And if you think about how that filters through to the stock market, look at the two best performing factors of the year, growth and quality, specifically over the last month. Growth and quality are up 4% and 3% respectively over the last 30 days. The two worst factors are value down 1.5% and yield down 1%. Why is that happening? I think to Steve's comments, you're probably going to have this rolling credit crunch in the economy get worse and worse as we get into the summer. It's going to become a lot more apparent that things are not quite as strong as you would have thought. given the pace of Fed rate hikes this year, maybe the silver lining is, hey, they finally got their way they could stop. And if you want to play that optimism, maybe the best way to do that, continue to do that, is in tech.